What type of questions come to mind when I say the word self-directed IRA or self-directed 401k? On today's podcast, we've got special guest Mike Todd from IRA Innovations. Mike's been in business for about a dozen years and specializes in working with real estate investors take their IRA funds and put them into real estate investments.
Welcome to the Investor Empowerment Series radio show, empowering your real estate investing with techniques, opportunities, and information, minus the BS and sales pitches. Now, please welcome the host of the Investor Empowerment Series, Joe Mueller from the Tough as Nails Investment Syndicate. Joe Mueller.
All right. Hey, Mike. Thanks for being on the show today.
Hey, Joe. Thanks for having me.
So the interesting thing about doing this podcast is a lot of times I have a lot more information about the guest when I ask them to be on the show. And you actually came to mind because I heard you on another podcast, the Savvy radio show that's ran by Stephen Van Cowenberg out of Oklahoma. So just because I need to know before we even get started into this, can you just talk a little bit more about yourself and how you got involved in the IRA business?
I'll be glad to do that. So my story actually goes back about a dozen years ago, Joe. I been a long-time investor, but I guess was fortunate enough or smart enough or just lucky enough, I guess, to say that I started in doing various types of investments right out of college in my early 20s and was located out of Huntsville, Alabama. That's where I was originally from and grew up, and got moved down to Florida with a job situation. And it turns out the office that I opened up was right next to a company that did self-directed IRAs, and I became a client of theirs and thought it was the greatest thing I'd ever seen. Cool. So much so that I decided to change industries, and I got in the industry. So I've been in the industry about 11 years now, and it's just a passion that I've got. And it's really because it lets people be in control. I mean, that's really what got me excited about it, is that, hey, here's a way for somebody to actually take control of their retirement plan.
So when you say that, you're referring to the self-direction aspect of what an IRA can do.
That's exactly correct. Most of us, including me, and that's my background. When I mentioned I started investing in the early 20s, my initial background was doing the stock market, and had some good successes with it, but also had some failures with it. When you saw the dot-com bubble burst and some of the technology stocks and things like that, and it's like, man, how do I get away from that and feel something more secure? And the self-directed IRA industry is what did that for me. So.
Okay, that's awesome. Can we talk a little bit more about what a self-directed IRA is? I know there's a couple different types, and how you maybe convert from one to the other. Just give a detailed explanation on those options that are out there through your company.
Yep, absolutely. So self-directed, when people say self-directed IRA, they just simply means that you're in control. So it is not an IRS term. So if you went to the IRS's website and Googled or searched for self-directed IRA, that would not come up anywhere. So when you say self-directed IRA with IRA Innovations, we mean that we put no limitations on you at all. We'll let you invest your retirement plan in anything that is allowed by law, but we don't offer investments in-house. It's up to you to go find those investments and do your due diligence to make sure it's a solid investment, and then you direct us to use your IRA to fund that investment, thus the term self-directed IRA. So it's still, when you have an account with us, it's still going to be a traditional IRA, which is your typical pre-tax type IRA, or a Roth IRA. There's also some retirement plans geared toward the small business owner, a SEP IRA or a simple IRA. So we can accommodate all of those types of plans, and they can be self-directed, again, which just simply means that there's no limitation of what the investment type is. So believe it or not, the law puts very few limitations on what you can do.
All right, I do want to hear about what you can do or can't do, but
okay.
You mentioned that if you go to the IRS website and type in self-directed IRA, that it won't come up because they don't govern those rules. Who makes those rules?
It's not that they don't govern those rules; they actually do. It's just it's not an official account type, if that makes sense. So it's just an industry term used for marketing. So the way we operate is governed by the IRS, just like any other custodian. So by that, I mean the rules are set in place that says, hey, here's how a traditional IRA operates, or here how a Roth IRA operates. And those rules are fairly lenient in that the IRS dictates, hey, here's the amount of contributions you can make, here's how distribution rules work, and here's what your investment options are. And again, and we'll elaborate on this in our conversation, but the investment options are vast. So when you go to other, what you would think of as a typical custodian, your brokerage firms, the fact that they only let you invest in the stock market, to buy stocks or mutual funds or bonds, is a limitation they put on you. It is not a limitation that the IRS puts on you. So again, it is governed by the IRS. It's just self-directed IRA is actually not an official IRA type by the IRS. It's just a descriptor that we use in the industry saying, hey, you, Mr. Client, are in charge of your retirement plan, and we won't put any limitations on you.
No, thanks for elaborating on that. Now it makes a lot of sense. So
Sure.
What type of limitations can one expect? Or let's maybe walk through some examples of how your company's helped investors make money in the self-directed IRA facet of the business.
Yeah, sure. So the number one investment our clients make is real estate, and that can be in various forms. I tell people, if you can think of a real estate investment, we've probably seen it done with our clients. So real estate is typically either, and with us, it's either a client buying a rental property, doing some sort of rehab and flipping the property, and we even see here in Nashville, quite a bit of new construction done. So by that, I mean the IRA is taking ownership of the property, so the deed shows the IRA as the owner. So the process is similar to any other real estate. It's just the IRA is the owner, and so the investment, the profits or rent, if it's a rental unit, goes back into the IRA in a tax-free or tax-deferred status. So there's no immediate taxes due in that scenario. And we see people make modest returns from 10+%, but then we also see people do wholesaling, or if you're familiar with that, where somebody puts a property under contract, puts earnest money down, and then assigns the contract to somebody else for an assignment fee. And then, of course, that fee goes back to the IRA with no taxes. So we've seen some significant growth with clients who have the knowledge and skill set to do that. And significant being, they'll put $1,000 worth of earnest money down and get an assignment fee of $50,000+.
Wow.
So and it's unique. I mean, that was a hard one to do, but we've had some clients in the commercial, dealing with commercial real estate who've seen things in that magnitude and bigger, actually, Joe. So
sure, there's probably a lot more base hits than there are home runs like that one, but I mean, it all sounds good
absolutely.
To me. Okay,
cool. Absolutely. And I do this with mine. I'm a cautious investor personally. The second, I mentioned real estate's the number one investment our clients make. The second most popular is private lending. Your IRA can act as a bank. And that's what I like to do with mine. One, it's somewhat simple. You don't have to spend a lot of time driving around looking at properties and getting quotes and things like that. And lending, we see folks on a regular basis lend monies out and get anywhere from 10 to 15% is pretty typical. So it's an easy way to put your money to work without having to go be a hands-on type person, and it's secured with some sort of collateral. And so it helps you sleep good at night that, hey, my money's out working for me, and it's not this crazy roller coaster ride that you may experience with the stock market.
For the layman who doesn't really know anything about IRAs, can you explain the difference between the Roth and the traditional style of IRA?
Sure, absolutely. So a traditional IRA is probably what most people think of. We call it a pre-tax IRA, which simply means as you make contributions into the account, and a contribution meaning you're taking personal funds where you've earned money and wrote a check to your custodian to contribute it into your IRA. When you did that, you got a tax deduction for the amount you contributed. So what happens is you got a deduction on your contribution. The IRA grows tax deferred, and so that means any earnings are not taxed at the time they are earned, but they'll be taxed when you take monies out at retirement age. So they'll be taxed as ordinary income. A Roth IRA, though, is that you are allowed to put your money into your Roth account. You do not get the tax deduction for making the contribution into the account. The earnings grow tax-free, actually, in that when you earn money, there's not tax then, but it's also when you pull money out at retirement age, it is not taxed either. So it's tax-free for life, unless the law changes. So, hey, I don't get the tax deduction today,
right,
but I'll never pay taxes on it in the future. Where the traditional IRA is, I get the tax deduction today, and I'll have to pay taxes when I take money out at retirement age.
Sure. And what are the amounts?
I'm a big fan of the Roth personally. It's just there are some limitations sometimes when, a lot of people have 401ks from previous employers, and when they leave the employer, you can roll those over into an IRA, and because a 401k is a pre-tax plan, those roll into a traditional IRA. So a lot of our clients just kind of have traditional IRAs by default as a result of the previous employer's plan.
They can't convert that to a Roth if they're...
So you can, and that's a great question. You can convert it to a Roth, but just keep in mind that your traditional IRA or old 401k was a pre-tax account. So if you convert it to a Roth, then you'll pay taxes on it. It'll be taxed as ordinary income. There's no penalty or anything like that. It's just a lot of people can't stomach the tax bill, if that makes sense, right? I've got $100,000 in my old 401k, and I want to convert it to a Roth. Well, that means you're going to have taxable income of that year of $100,000 or an extra $100,000, and there's been no taxes withheld on it. So a lot of people just can't stomach, and I get that. People have to do what's best for them. So
sure,
but both plans are easily self-directed, and they're both very powerful when you put them to work in a self-directed IRA, kind of like what we're talking about.
Sure. No, that's awesome. Well, you touched on the difference between a Roth and a traditional, which I think we've got that understood at this point. I know there's some annual limitations on how much can be contributed into those types of plans. Can you go over that real quick?
Sure. Your annual contributions, a couple of things, is one, to contribute to an IRA. So, and again, this is you taking money from your personal earnings and putting it in your IRA. You're limited to $5,500 a year for either the traditional or the Roth or combined. So that's your total contribution into your retirement plan until age 50. And at age 50, you can do an extra $1,000. So if you're 50 years or older, you can do $6,500. And that's, again, combined between the two. So you can put it all in the traditional, all in a Roth, or some combination of those two. So your contribution limits are fairly insignificant. I say fairly. If you're just getting started, you're going to be a few years of having any substantial money into the account, unless you can do like one of those contract assignments or something similar that we talked about. So,
yeah, turn your $5,500 into $50,000. Yeah,
absolutely. I've seen it done.
Well, that's why you're here, because we're gonna get into how that can be done too. Yeah, I had another question related to that, and it kind of skipped my brain here. So give me a second.
While you're thinking, let me mention something. We kind of talked early on in the conversation about that the IRS really puts few limitations on what an IRA can invest in, and I gave some examples of real estate and private lending. So let me just kind of elaborate, if I can, on what limitations the IRS actually places.
Okay. Please do, yeah.
Yep. So believe it or not, the law doesn't tell you what you can do. So if you actually look at the law, it doesn't say your IRA can buy stocks and bonds and mutual funds or real estate. It doesn't mention any of those items. It mentions what you cannot do. And the law only gives you two things from an investment type that you cannot invest in. So it says you cannot invest in a collectible, so you cannot purchase an art collection, stamp collection, antique collection, etc., and you cannot purchase a life insurance contract. And that's it. So I tell clients, I said, if you can think of an investment outside your IRA, the probability is high you can do it inside your IRA as long as you're with a custodian who doesn't put a limitation on you. And all the stockbrokers will put a limitation on you. So your Fidelity, Schwab's, Raymond James, etc., they limit you to the stock market because that's the space they're in. It's not that they've got some hidden agenda. It's just that's where they play. I use an analogy. I said it's kind of like going to Subway and trying to order a cheeseburger. You can't. And it's not because it's against the law, right? It's just that's not the space they're in. They sell sub-sandwiches. Well, it's the same with the brokerage firms. Their space is buying stocks, bonds, and mutual funds. So if you're wanting to do self-direction, you've got to find a custodian that's not focused on just the stock market.
That's actually pretty interesting you brought that up, because even hearing you say this and listening to you talk about the options that you can invest in through an IRA, I think that a lot of people out there are probably getting squeezed by their we'll call it the custodial company, whether it be the stockbroker or whatever, because that's just not the space that they play in, like you said, and they're under the impression that they can't invest in something based on who they're holding their money with. So
that's right.
Yeah, I mean, that's actually a great piece of advice for the listeners to kind of pen down, is that, if you're not able to utilize your funds in the type of investment space that you hope to be in, then maybe you need to consider, looking at an alternative option to the company you're holding it with, because obviously those things seem to be out there.
That's right. And it's not necessarily a negative on the company.
Sure.
Right? It's just, I had a real senior level stockbroker in my office about 5 years ago, and I mean, he's 20 years my senior. Guy's been in the industry 35 plus years. And I just asked him the question. I said, have y'all been trained on what the law actually allows? And of course he says no. They're brought in, he goes, and trained to get their securities and advisement license, the appropriate licenses to do that at an early age. And then they're trained on what platform their company operates. They're not educated, and it's not a knock. It's just since they're not offering that as an option to their clients, they're not trained in that area. So, like you said, if your current custodial company does not allow you to do what you're trying to do, it's certainly worth investigating other companies to see if they might offer that, like what we do.
No, that's great.
Yep.
And I know we're going to talk about how to get a hold of you and the company that the company you run. We're kind of going to save that from the end. And I do remember the question that I wanted to ask you.
Okay.
And it was back to the annual contribution. So I've heard, and I don't have any experience with this, but if you are with an employer, can you actually contribute? Like if the employer matches, there's any type of situations where employers match the contribution you're putting into that investment vehicle, like let's say an IRA or 401k? So
an employer would, in the scenario you're describing, it would be in a retirement plan that the employer set up. So if you wanted to contribute to your traditional or Roth IRA, your employer does not match those plans. So
okay.
What you're describing would be an employer probably set up most likely a 401k, which you can certainly contribute into, and those contribution limits are much greater than what I described, but they are bound to the employer. The employer may or may not do matching. They may or may not. More times than not, the employer is going to have 6 to 8 mutual funds for you to choose from. But the odds of you being able to self-direct those are slim. Mm-hmm. It's not illegal. It's just the employer normally wants you to leave those funds with them as long as you're an active employee. Once you leave the employer, you can certainly move them over and self-direct them. But while you're active, the probability is low. It's not impossible, but the probability is low if it's your current employer's 401k.
Sure. No, I understand. Now, we're talking about 401ks. Do you guys offer the self-directed 401k as well?
We do, and that's a great question. It's called a solo 401k or an individual.
Okay.
Solo 401k or individual 401k. It's a very simplified 401k plan for small businesses, and I mean small. It's really for the sole proprietor. So it can be structured as an LLC or anything like that, but to qualify to do one of those, you cannot have any full-time employees other than the owners and their spouses.
Really?
So if you have any employees, you do not qualify to do the solo 401k.
Right. So my situation, I have several employees here at my company, so I wouldn't qualify, which I think is what I've been told in the past.
That's right.
But what if, I'm not trying to skirt the laws of the regulation, but can I start up a secondary company that's investing in real estate and I'm the only employee or the only person that owns it and get involved with something like that?
I mean, you could confirm that with your CPA, but I would expect that, yes, it's just you'd have the contributions into the solo 401k are tied to the employer that the plan is set up under. Does that make sense?
Sure.
So if you start off, hey, I've got this new real estate investment company, then your contribution amounts will be tied to the income earned through that company.
Understood. Okay. Cool. No, I'm glad we touched on that. And my understanding is, which I don't know a lot about it, which is why I love having. I'm really enjoying having you on the podcast because this is a lot of learning going on in my own brain. I'm writing a lot of notes down here. Is the 401k compared to the IRA aspect is what's a better situation for someone to be in, do you think?
Yeah, if you qualify to do the solo 401k, in my opinion, that's the best plan that's out there. And the reason is it is your contribution limits where we mentioned the traditional IRA or Roth IRA is either $5,500 or $6,500. The solo 401k is a percentage of the income earned with a maximum contribution for 2017 of being $54,000.
And what's that percentage?
Well, it's kind of a two-step approach. Think of a 401k at a large company where you mentioned the match, right? The employer puts in a portion of the money, and then you as the employee defer some of your income. So conceptually it's similar. When it's a solo 401k, the employer can do a match up to 25% of the income.
Okay.
So that part's significant. And then you as the employee, which you're one and the same, but as the employee side, you can defer a portion of your income. I think it's about $18,000. So you're making $100,000 a year on your little real estate business. You could easily, it'll be a little bit over $25,000 that you could get into the plan.
Sure. No, that's pretty cool. And what's interesting is I released a podcast this morning, and I mentioned one of these investors that works with us, and he's got, I think he's going under contract for his fourth property. He's in the process of closing. And just last week, he started his first LLC, and he's a single member LLC right now. So would that apply to someone like him if he's interested in maybe putting those funds towards a solo 401k?
It absolutely should.
That's awesome.
Without knowing the details of a situation,
sure.
I would see no reason why he could not.
Yeah, because there's a lot of investors, I think, that they feel like they have to have some form of entity, to create that veil for asset protection, and they just have an existing LLC. And typically, let's be realistic. I mean, I'm a little bit more of an anomaly because I'm running a brokerage on my end and have other investment business stuff going on. Well, I like to say stuff, but the norm is probably more the single member or husband and wife type team that's in these small companies that are just using them to buy or sell property, smaller numbers, things like that. So
absolutely,
that's a great opportunity. So I do have more questions, but real quick, let's talk about the company, the name of the company, how they can get more information about you. Just touch on it real briefly.
Yeah, sure. The company is IRA Innovations. We've been in business for about 13 years now, so we're not new at this. The website is IRAinnovations.com. Phone number is 866-333-0411. That rings to my office here in Nashville. And if somebody wants to reach out to me via email, they can shoot me an email at mike@IRAinnovations.com.
Awesome. Cool. All right, let's continue on. This just came to mind. What type of turnaround do you need on an investment? So let's say I've got, and we're going to walk through a Joe Mueller scenario here. I go to the sheriff's sale and I put down a deposit on something, and I need someone to borrow private money, and I need this money within 24 hours. Can you guys turn that type of thing around that quickly, or do you need more time than that? If it's like I'm borrowing from let's say one of your IRA clients wants to lend me the money.
Sure. Company turnaround time is 48 hours. That's our official response on any funding. We do have some scenarios where we can, and we do it many times actually, where we can do a funding in 24 hours. We need kind of a heads up from the client if at all possible. But,
sure.
1 to 2 business days is very typical for us to process any funding request. And the assumption, of course, the only assumption in that scenario, Joe, is that the client is an existing client with us and their accounts here. Right?
Of course, right, because that's going to take some time, yeah.
That's right.
Now, do you oversee, and I have borrowed from an IRA in the past from another investor. He knows who he is. He's probably listening because he listens to the podcast. He was able to do that for me in that exact scenario, and I was just curious. We were able to turn things around pretty quick, and I didn't know if that was typical or what the standard was, so thanks for giving me that answer. Now, in that situation, they actually wanted to review the loan documentation between the IRA and me. Is that fairly typical as well?
Every custodian I know would have a similar process. So the process typically would be we've got some internal paperwork. It's just a real simple form the client would fill out, that said, hey, it's client, John Doe that's going to be lending money to Joe Mueller and it's whatever the loan amount is and the interest rates. We'd have our internal form and the official investment document, which in this case is the loan. So yeah, that I would assume that would be typical
cool.
within the industry. Absolutely.
Yeah, I'm just curious, just comparing notes.
Yep.
That's all. That's cool.
No, absolutely.
All right, so let's talk a little bit more about some of the experiences that you've had or your clients have had in this space, because I know you've mentioned the little research I've done has shown some awesome successes, and I really want to motivate some of these listeners as to what the possibilities are if they were to get involved in either having you guys as a custodian and then lending out, or using that money to invest in property. I know we touched on wholesaling, but what's the potential for some of these opportunities? Let's talk about some deals, some stuff that's happened.
Well, potentially, in theory, the potential is limitless, to be honest. I mean, anybody who, watched the presidential election from 4 years ago when Mitt Romney was running, I mean, he has made the news just how, he grew his into the millions of dollars, his self-directed retirement plan. So in theory, you can get it as big as you want. So practically, though, what do we see? I mean, the best success stories I have seen has been the wholesaling, when you say what's the return on investment. So the wholesaling scenario that we described earlier, where a client takes a small amount of money, and I mean, this is real. A client opened an account with less than $1,000, puts a property under contract. So they wrote literally a $500 earnest money check, and then within less than a week, that contract was assigned to somebody else for an assignment fee that approached six figures.
Wow.
And so within days, this $1,000 turned into, right at $100,000, and that particular client's done it a few times. So that's probably been the single quickest turnaround type scenarios that I personally have seen.
Sure.
But we see client, the real estate market in Nashville, for example, is just booming. A couple of years ago, appreciations double digits a year. So you see clients buy properties and rehab them and sell them, and it takes more money to do that, but they'll rehab them and sell them, and make 50 to 75 to $100,000 on a property as well. It just takes more money to play in that space.
Right, and all that money comes from the IRA and goes back into the IRA when it's all said and done. Correct?
Well, typically it does, but it doesn't have to. So, an example on a rehab, the IRA doesn't have to be the sole person to do the rehab, if you will. So it could be that, hey, Mike's going to, I'm going to use my IRA to do a rehab, and I'm going to partner with my buddy Joe, and we're both going to be listed maybe on the deed for the rehab, and we share in the profits or something. So you can do what I call it partnering, but there can be multiple owners in a deal. Absolutely.
Yeah, but the funds, if the IRA provides, so maybe what you're suggesting is you buy and we'll just use arbitrary numbers, but you buy a property for $50,000. Maybe the partner, maybe Mike, and maybe it can be done both ways. We're going to find out in a second. But maybe Mike contributes the initial purchase price, and let's say the property needs $50,000 in rehab, and then the IRA, provides that $50,000. So you're both
Sure.
providing an equal amount. Let's say the profit is another $50,000. How does that? Can that be divided up? Does it have to be divided up equally? Like 25's got it. 75 goes back into the IRA and 75 goes back to Mike, or can it be just set up like however you want to do it? So maybe only $5,000 goes back to the IRA.
So it depends on who that's a great question, and it's dependent on who the partner is. And I say that if the example that you just described, where hey, maybe it's my IRA paying for half and you paying for half, then those proceeds can be split any way that we agree.
Really?
If that makes sense. So, and there's also a couple of ways to structure the deal, right? It could be that, hey, Mike's IRA and Joe, the individual, are going to take joint ownership of the property. So we're both listed on the deed as an owner.
Right.
And upon sale, then we both sell it. We both have to sign as sellers, and then that scenario, typically it's split proportionally to the amount of ownership.
Okay.
But it also could be that, hey, Joe owns the deal, right? You're going to take possession of the property, but maybe my IRA lends to it as a loan, and in that loan it could be structured as a profit-sharing agreement. So it doesn't necessarily have to be a loan at 8 or 10%. It could say, hey, Mike's IRA is going to lend Joe money for the purchase and rehab of property at 123 Main Street, and upon sale of the property, my IRA gets 25% of the return of principal and 25% of the profit, or 50% of the profit, whatever we negotiate. But you're the owner of the deal. Just my IRA is an investor.
Interesting. So it sounds
so either one of those
flexible.
would be, any one of those would be great and works fine. We see it done both ways. And again, the split or the amount of return coming to each investor is just negotiated between the two parties. And when I mentioned that it's dependent on who the other party is, believe it or not, you and your IRA potentially can partner on the same deal. And in that scenario, so if Mike's IRA owns half the property and Mike, the individual, owns half the property, then in that case, it has to be split proportionally to the amount of funding.
Wow. Yeah, you're kind of blowing. I'm going to do the
I
whole.
know. That one's getting,
like you're blowing up my head right now.
Deep.
That's incredible. So that makes sense to me, and that's awesome. I had no idea that you could do that. So if I had I don't have an IRA, that's going to change. That's changed. 2017, people, new goal. If I have an IRA and I partner 50-50 with myself, which makes sense because the IRA is kind of like separate, right?
That's
I
right.
would have
it's
to
its own entity. Yep.
When we go into the property together, I would have to proportionately pay the IRA back the proceeds from the sale in addition to the principal investment is what I'm hearing, correct?
That is correct.
And I guess back to my original question, what I was trying to figure out was if there's an investment of $50,000 and there's a $25,000 profit, does that entire amount of profit on your ownership portion or however you've done your profit sharing, does that have to all go back into the IRA, or can an investor say, hey, I'm gonna take a little bit off the top here. I need $5,000 for administrative costs or whatever?
No. So that's a great question. So the IRA, so in the example where you're partnered with yourself, the IRA has to keep its share of the profit. You can't keep. In the case that was maybe where's my IRA and you, if for some reason you and I agree that Joe does get an extra $5,000 of the profit because he was project manager or administrative costs, that would certainly be acceptable as well. But Mike, since it's my IRA, I cannot personally collect any funds that was earned by the IRA.
Okay, that makes
Does that make sense?
Yeah, no, that totally makes sense now.
Yeah, and here's why, and we haven't even discussed this, Joe, but basically the IRS says an IRA holder cannot receive any sort of personal benefit from a transaction the IRA does. So Mike, the individual, can't get monetarily compensated from my IRA.
Perfect. Yeah, I just wanted to clarify that point, and that was my understanding. And I've also been told that, and maybe you're going to correct me on this, maybe, I don't know. If the investor gets involved in the deal, and I'm going to say that term kind of loosely, but can they hold the IRA, they provide the funding for it, let's say, in whatever capacity it is, whether it's partnering with themselves or, in that case, if you're partnering with yourself, can they physically go swing the hammer on the property? I thought there was some type of restriction on that.
That's a great question, and to answer your question is no, and I'll explain why. I mentioned that you're not allowed to do business with your IRA or benefit from it. Well, there's actually a little more to it than that. The law lists a handful of people that the IRA cannot do business with in any form or fashion. They call them a disqualified person is the label they give them. It's easy to remember. I tell my clients, I say, visualize yourself on your family tree. The disqualified people, if it's Joe's IRA, the disqualified people are you and your spouse, and straight up and straight down on your family tree. So parents, grandparents, children, grandchildren, and their spouses cannot do any sort of business with the IRA. So that includes buying, selling, exchanging, or leasing property. But that also includes providing services. So in the example of going in and doing the work, then you're not allowed to go do the work. And so the fact I partnered with myself, if it's Mike's IRA and Mike the individual, I still can't go do the work, and it has nothing to do with because of what I own. It has everything to do that the IRA owns a piece of the property, and that disqualified rule is in play.
Okay. All right, good. That's a great clarification, because I know there's a lot of investors that have
Sure.
considered doing it we'll call it the wrong way. But yeah,
That's right.
that makes a lot of sense.
Well, and it's a great point, right? I mean, I have a lot of folks that I talk to, because I own some rental properties and things too, and I like to do work and capable of doing it, and we all like to try to save money. But I just tell people, when your IRA is involved in the deal, you just need to evaluate the deal to make sure, hey, it's going to be a hands-off investment. So I'm going to have to pay these people to do this, and is it still a good investment with that in mind? And if so, then great.
Okay, cool. No, I like it. Tell me a little bit more about some of the experiences you've had, some of what your clients have been able to accomplish starting from these small amounts. You mentioned rental properties. I mean, what have you seen with some of the clients that have worked with your firm been able to do just inside their IRA?
Well, so the rentals are very common. They're not the grand slams, if you will, not typically they're not like we see, but it's certainly a way to consistently grow the retirement plan. So just like any other rental that somebody might consider, the IRA takes possession of the property, the rents go back into the IRA. Depends on what part of the country you're in, or how strong the rental market is in. But you still see clients average 10+% of tax-free or tax-deferred growth in their IRA, through a rental property, and then you've got a hard asset within the IRA versus here's a mutual fund that may go up or down in value. So it's a great long-term strategy, which fits well with retirement plans, right? Most of the clients here, they're not 70 years old, trying to use their retirement plan today. They're folks in their 40s and 50s and even 30s, where hey, I've got this retirement plan that I want to put to work that's going to be working for me for the next 15 plus years, and the rental model works well for that. Hey, it's not the grand slam where I'm going to make $100,000 in 1 year, but I've paid or paying for this rental property that's going to easily make 10+% a year, and over the long term probably has some significant appreciation in it as well.
No, that's awesome. So if I'm the guy who, let's say, is listening to this podcast right now, and I'm into the stock market, let's say I've got, I'll use another number. We got $50,000. I've been playing around on one of these company, E-Trade account, and I've accumulated something that I feel comfortable with, but I don't really, see a good forecast in the stock market. What are the steps that it might take to kind of move that into the IRA side of it and become more of a real estate guy instead of a stock guy?
So is the scenario you described, is his stock market in a retirement plan today, or is there?
Well, let's just say you've got somebody that's got money in the bank in an E-Trade account. I understand there's limitations on the annual contributions, which I know we touched on. But if I want to start migrating into more of the IRA side of the business, I mean, what are the next steps to work with your company to do that?
So the process is fairly simple. As the client opens an account with us, which is just an account application, so it asks for personal information. Account application gets the account established, and then if their E-Trade account, in our example we used, if it's a non-retirement plan type of an account, then they would have to just do an annual contribution into their account here that we discussed, the $5,500 or $6,500. Okay. But, and this is probably the more common scenario, the person has the E-Trade account or wherever they're at, and it's an IRA. Mm-hmm. It's already an IRA. Then they can do what's called a transfer, and that's initiated with us. It's just another form of ours that says, hey, it's Joe. The account holder's Joe, and he's got an account at an IRA at E-Trade, and he wants to move the $50,000 to us, or a portion. It doesn't have to be all.
Sure.
But fills out the paperwork on our side. We initiate it. We'll send that form along with some corporate information over to E-Trade, and then they'll send us the funds, the amount that you requested, whether it be the full 50 or just a portion. That, depending on the sending custodian, that process generally takes 1 to 2 weeks.
Okay.
And then the funds are here they're here and available to invest at that point.
Ready to roll.
Ready to go.
What's the is there an annual deadline for that $5,500 contribution? And I guess let me make that a two-parter. So I'm going to start my IRA. I'm going to do a Roth, in 2017. Can I contribute did I already miss my deadline of January 1st, or do I have like up till April 15th to contribute to 55, and then maybe on April 16th I can contribute another 5,500?
So that's a great question. Your deadline for making contributions into the traditional or Roth IRA is the tax filing deadline, not including extension. So April the 15th is your deadline to make 2016 contributions. So there's still a few more months if somebody wanted to start for 2016.
Awesome.
And you can start. So that's the deadline, and the start date is January 1st. So, for example, you could, in theory, make a 2016 contribution into your Roth, and you could go ahead and make a 2017 contribution into your Roth as well.
Awesome! I'm so excited. I love it. So that could be a good head start for somebody who's got an extra $11,000 to invest into the retirement fund or the Roth self-directed IRA. That's incredible. Right. Love it. I'm so excited. I'm doing it. It leads naturally to the next question. Let's review again. How do they get? I know you got some videos on your website, so please give that out. Talk a little bit more about how they can get a hold of you, and the best point of contact at your company, so we can get some people to start investing in their self-directed IRAs through you guys.
Sure. So again, the website is just IRAinnovations.com. And as you mentioned, we do have some recorded presentations on the website. If you go under the events tab, believe it or not, it's where those videos are, and it's just some recording of some live events that we did.
Oh, cool.
You can also reach me. My name's Mike Todd, Todd, via phone at 866-333-0411. That is a toll-free number, and people are always welcome to email me. My email address is just mike@IRAinnovations.com. And, it's a learning process for most people, Joe, so I encourage people to ask as many questions as they need, and many times it takes numerous conversations to get those questions addressed, because as they get further into the process, it seems to raise more questions till they get a handle on it. And again, I welcome the questions. So as however anybody might want to reach me.
I think that's great. I mean, I'm glad we did this today, and I just want to also mention, and this is going to be my selfless plug, I guess, is if anybody has any funds that they have sitting in an IRA that are dormant, myself, I'm always looking for funding for my deals, and we can negotiate some type of a deal where they could lend from their IRA, as well as a situation where we could help them connect with some investors that are doing the same if you're interested in private lending or partnering on a deal. And I didn't really I kind of wanted to mention that earlier because I feel like, and this is just my own brain, I feel like a lot of people think, oh yeah, my accountant or my financial planner says I got to get involved in this Roth IRA. I got a Roth IRA. It's awesome. And then it just, what do you do next? How do you find those opportunities? So I think it goes back to a lot of the stuff that I'm constantly beating the drum on, which is, talking to people, networking, making connections and finding out ways to invest that money. So, I mean, there's opportunities out there, people. You just got to have your IRA set up, and you can start utilizing it and making some money for basically potentially sitting back and watching it all happen, right?
That's exactly right. And I mentioned lending. I personally do that with mine. I'm a big fan. That's an easy concept for most people to grasp. So, and when I lend, I do exactly what you were just describing. It's like I get out and network and meet people and figure out what they're doing and see if it's a good fit for what I'm trying to do. So
that's incredible. No, that's awesome. Thank you again for spending the time with me today.
Yes, sir.
We're going to get this podcast out there to the masses, and I really appreciate it because this, like I said, this is kind of one of those topics that's not necessarily readily accessible out there. I mean, it's blasted all over the place if you Google it, but to really hear the ins and outs of how it works is really, I think, where that value, that information was today. So thank you again, Mike.
Thanks for having me, Joe.
All right, we'll talk soon.
Yes, sir. Thank you.
Thanks for listening to another episode of the Investor Empowerment Series radio show. Be sure to tune in next week for another empowering episode. We welcome your feedback, so please rate us on iTunes and Stitcher, and visit us at www.investorempowermentchicago.com or tennisgrouprealty.com.